The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody. Happy Memorial Day. Somebody told me you're not supposed to say Happy Memorial Day because of the sacrifice. And we are so thankful for everybody that has stepped up to the plate and been there for our country. But we really do want to celebrate our freedom. And so I say Happy Memorial Day. I thank you for all the first responders, everybody that served in our country. And this is Ask the Tax Lady, and we're going to talk about money and taxes, and we're going to get you ready for this year, last year, and everything moving forward. And I'm joined in studio with Chris Fabian. Hey, Chris.
Hello, Esther.
Hey, Christopher. So I think Tiff is getting her hair done today, right?
Yeah, we decided to give her Saturday off.
All right. Well, and because it is Memorial Weekend, and so we want to, we're kind of doing it just Chris and I, but we have some great things to talk to you about. First thing we want to talk about is our upcoming June 1st seminar, right?
Yep. Ready, set, retire. It's a great tool for people who are thinking about retiring, anybody from age 55 to 65. Are you financially set to retire? Should you start collecting Social Security? Should I live off my investments? What about my health insurance needs? Well, if I retire before 65. I mean, there's so many questions, and we're going to have the experts there to help you figure this out. And
I mean, can you imagine having an attorney say, we will talk to you about nursing home, we'll talk to you about elder care planning, we'll talk to you about your wills, we'll talk to you about your finances, and there's no charge. And same thing with Mike Hayflick from the Financial Guy is going to talk about Social Security planning. There are so many great guests that we have, and it's a hands-on workshop, so you actually bring your questions and your stuff, and we're going to sit there. Our experts are going to be in the bullpen helping people that have questions. And the thing is, we want you to walk away with an understanding how to read your financial statements. Do you have your beneficiaries? What's the 5-year look back? Should I gift my house? Should I do a life estate? All those kind of things are so important. It's absolutely free, and it's our blessing to you as our listeners, because we want to make sure that the people of Western New York really have their finances together. And if you haven't registered, I think we have room for maybe 10 or 15 more couples in the seminar, and you can do it online at egtax.com, or you can call Tammy on Tuesday at 632-7886, and we'll get you in. It is really going to be, I'm really excited about it. Plus we have, if you don't have health insurance, we have Tim Eliason there from EG Health Connect that'll help you to see some of the options you have from your health insurance perspective. It should be great.
Yep.
Right?
And,
Chris?
and if Tiff was here right now, would say, and we're going to talk about budgeting, because when you retire, that's a totally different financial aspect of life. You're used to maybe bringing in $130,000 a year between the two of you, and if you both retire at once, your income could cut down to $60,000, and that's a big change for some to realize.
It is. And the other thing is, the last thing we're going to do is everybody's going to get like a 5 or 6 page handout that basically says, if I'm gone. And this is something that I think is so important, where it says, if I'm gone, here is where my will is. If I'm gone, this is my bank accounts. This is the account numbers. These are my passwords. These are my beneficiaries. This is my wish as far as how I'd like my funeral handled. This is where my life insurance is. These are the assets I own. And this is so important. Anybody that has had lost money discovered. And when you go to that New York State website, that there's been money there. Many of it's due to the fact that your heirs did not know where your assets were because you didn't tell them. And everybody was way too polite to say, hey, Mom, hey, Dad, where is the stuff? Because in the event we pass away, and this is going to happen unless some miracle happens and they keep longevity for another 1,000 years. It's all in the future for all of us. You want to make sure that your heirs know where your things are. So the last thing we're going to do as part of this workshop is the "If I'm Gone" letter, so you can walk away with that. Right, Mr. Chris?
Yep.
All right, and before, and again, 803-0930, 803-0930, star 930 on a cell phone. And if you want to text us, you can text us at 3930. And I think before we take our break, I want to go with Mike in West Seneca. Hey, Mike, how can we help you?
Yeah, you referred to this on a program last week. I believe somebody called in and said the IRS claimed they didn't have a return. It was a past return. I send it in. I always send them in return receipt until I catch up, push everything to the following year. Accountant said that I will have no problems, will owe nothing, so we decided to ask for the full amount. Actually, I overnighted it because of what you said, being a past return. It was supposed to be in their hands, and everything shows that they received the return receipt stamped, and then I get a letter says we don't have your return, and on.
Okay, so let me ask you a couple questions. When did you mail in the return certified mail?
I overnighted it because
when?
What you said.
When?
That it's supposed to be in their hands.
No, but when, Mike? When did you do it?
I believe it was the
April
13th, April 13th.
All right. Then when did you get the letter that says that they haven't gotten it?
Oh, let me see. About 2 days ago.
Okay. Now, at the top of that letter, at the right-hand corner, it's going to have a tax year. Does it say the 2018 tax year?
No, it's just 2015. It's a pass.
Okay, so the return that you sent in was late. Is that correct?
No.
Was the return that you sent in on April the 2018 return or the 2015 return?
They're saying they didn't receive the 2013 return. What they claim in the letter that they have on credit, and where do they want me to go with that money? That is the amount that matches exactly what the 2014 return had that was supposed to be pushed to the 2015 return.
Okay, so you need to sit down with your accountant, and you need to make the call to the IRS because you're going to have to kind of unscrew the spaghetti, because if they've been applying refunds based upon what they thought the best thing should do with the money, then you have to explain to them what happened. So what I'd suggest you do is you can go to your accountant and they can make the call with you, or you can come into our office and there's no charge and we'll make the call with you to make sure that they got all those years done correctly. Chris, you got anything to add?
Yeah, no, it's definitely got to be a call to them to see why they're saying what they're saying. And it may take an hour and a half on the phone getting to the right person, but it definitely has to be done.
But you really don't want to assume, because you're right, but unless you go into their database and make sure that they've applied your refunds correctly, you might be very disappointed in the outcome. So that's something I would absolutely do on Tuesday, Mike, if I were you.
The amount of the refund, the problem is they're claiming they didn't receive this.
I know. That's why you really got to call them, and we can fax them over a copy of the return. But the important thing is make a mental note that you're going to do this on Tuesday. Call us, call your accountant. The phone call needs to be done.
I already did both of those, and I talked to the IRS.
Oh, good.
It's not in the database yet, and it's almost 6 weeks. Probably it was I think Tuesday will be 6 weeks.
But you have the return receipt request, so you know that they're going to be processing it.
He claims it's not in there yet, and he can't understand why.
But you have the proof that you sent it in, right?
Right. And
So again, but your accountant could fax it over to them.
I know past year return like this has to be mail, paper.
Right, but again, to prove that this is again, we don't know what they said. We don't know what your accountant said. So again, if you need our help, we're there to help you on Tuesday. Okay.
Okay, but
All right, thanks, Mike. Have a great Memorial Day. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back on the other side. We're going to talk about things that you need to know for your finances and your taxes. Thanks for listening. And that's Memorial Day weekend music. You know, Frank, we got to get patriotic. So at the bottom, after the news, we got to get patriotic, okay? I'm Esther Gulius, the tax lady from EG Tax. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and we're talking about things that you should look at in your finances, because I'm going to tell you, you can do something and it can cost you a lot of money, and you aren't even aware of it. So these are some of the things we want to talk about. And the first thing, Chris, I want to talk about is, where not to get money. And one of the things would be short-term stock sales. What is a short-term stock sale, and why is it not as good as a capital gain?
Yep. A short term is a stock you held, or even land, or some maybe you're flipping a house, an asset you held for less than a year. If you hold it for less than a year, your gain is taxed as ordinary income, which means whatever tax rate you're at, that's what tax rate you're going to pay. Whereas a capital gain asset is something you held for more than a year, gets a special tax treatment. So if you're in the 12% bracket or lower and you have a capital gain, you actually pay no tax on that stock.
All right, so let's do apples to apples. I got $10,000 in a stock, and I want to sell it 2 days before the 1 year holding period. If I'm in the 12% bracket, I would pay $1,200 in taxes. But if I hold it for 2 days and it exceeds a year and a day, then I pay 0%. So I'd save $1,200 just waiting 2 days. Right?
Unbelievable.
But those are little things people have to consider if you don't want to get stuck paying taxes. So again, we want to talk about some of the smart things that you can do to make sure that you don't overpay your taxes. Our phone number is in studio, 8030930, 8030930, star 930 on a cell phone. And we got Kelly calling from Naples, Florida. Hi, Kelly. How can we help you?
Hi, thank you so very much for taking my call. I so enjoy listening to you guys. I'm actually going to be moving back to Buffalo, and I just had a couple questions. I love listening to you guys. I have about $30,000 worth of credit card debt, and I'm wondering, would it be more advantageous to use like my retirement money? Should I take out money for my 401k? Should I do something to pay that down? And then like recoup it on the other side.
Okay, Chris, why don't you give her the skinny on this?
Yeah. But first, why are you moving back to Buffalo? No.
Well, I'm switching with my employer, so it was just
No.
Okay, well, we got to answer the question. So here's the thing. So how old are you, Kelly?
I just turned 51.
All right, so you're under the age of 59 and a half, and that's a real operative thing, because if you take money out of a qualified plan and you're under the age of 59 and a half, then two things happen. First of all, unless it's a Roth vehicle, it's going to be fully taxable when you take it out, plus a 10% penalty, both in the federal and the state. Right, Chris?
Correct. Yep.
So on your $30,000, if you were to take, I don't know what your tax bracket is, but let's use that 12%, you would pay 22%. And since you're in Florida, if you do it before you move back to Western New York, you'd pay 22% on the $30,000 if you do $30,000, and it's going to cost you $6,600 in taxes. So if you wait till you're 59 and a half, all you're going to have to do is pay the 12% rather than 22%. And if you wait to take the money, if you take the money while you're in Florida, again, you pay 0% taxes. But if you wait to take it in, if you take it while you're in New York, you're going to have to pay New York state taxes as well. So taking money out of your pension plan is not a good thing. What I'd suggest you do is sit down with somebody and do a budget to see if you can't work your way out systematically out of the debt, or you might even have to consider a bankruptcy, which would be something you'd want to do. But taking the money out of your pension plan is meant to be just that. For when you get older, it's meant to have, it's kind of like holy to the IRS, and they want to really slap your hand if you're looking at a pension plan to pay off your debt. And so it's just not a good thing to do. And I thank you for calling, Kelly. I'm Esther Gulias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. And if you want to text us, we're at 3930. But that happens a lot, right, Chris? People look at their pension plan like it's a piggy bank.
Oh my gosh! And by the time they come in to see us during tax season, we have to tell them, "I'm sorry, you now owe the government $5,000, or in this case, $6,000." And they're like, "But I have no more money. How am I?" So they don't plan for that aspect of it. Yeah, it's nice to get rid of all your credit card debt, but a lot of people just end up in debt with the IRS, and they charge a lot more interest and penalties than even credit cards sometimes. So you got.
Right. But the whole thing is you can plan it. And so let's talk about ways you can get money that doesn't cost you money. It doesn't cost you taxes. The first thing you want to do is, and I didn't talk to Kelly about it, but she could have looked at borrowing the money rather than withdrawing the money, right?
Right.
So if she borrowed the money and paid herself back, she paid herself back with interest. That's not taxable, and there is no penalty.
Right. Yep. And you're paying yourself the interest, which is incredible.
Right. And so that's one place you can get the money for free. Number two, take a look. I don't know if Kelly has life insurance, but if she has life insurance, she might have a cash surrender value on it, and she could take the money out of her life insurance policy tax-free.
Yes.
Right? Gifting, I have to tell you, parents are a great source of free money, because if your parents, and I'm thinking parents because usually your parents have some extra money if they've been prudent and good investors. Parents can give you, or anyone can give you a gift of money, and that is tax-free money as well. And so really, somebody might want to say to mom and dad, sometimes you got to eat humble pie, and that's the really hard part about dealing with family, but going to them and saying, gee, could you loan me, or could you give me $30,000? And that doesn't mean they're not going to be, they're going to be happy with you, but the reality, that's sometimes where family really pays off, and they can help you to pay off that debt, and it would be completely tax-free. The other thing is you could sell your personal home. If she had a personal home and she lived there for the last 2 years, the first $250,000 of gain would be tax-free. If she were single, $500,000 if she's married, filing a joint return. Tax-free money.
Yep. I mean, she could, if she's moving back up here, sell her personal belongings.
There you go. So you sell your stuff. And again, usually you sell your personal stuff at less than what you paid for it, so it's completely tax-free. So these are areas that we can use to, if we need money, as opposed to going to the 401k well, which is going to cost you a fortune. Let's go back to the phones, and we're going to talk to Frank in Williamsville. Hey, Frank, how can we help you?
Hi, yes, sir. I got a problem here that I would like to be able to speak in general terms, not specific dollar terms.
Sure. Oh, that would be great.
Okay, so I'm on disability. I left my company 2 years ago. I have Parkinson's. So I'm all settled up now that I'm Social Security and a private insurance company both contribute to my monthly disability check.
Sure.
Conundrum is this. I have a pension with my former company that, now I'm 55 years old, as I mentioned there, that it has a lump sum value of a lot of money, okay?
Mm-hmm.
But if I elect to take that money, the insurance company that shares my disability payment every month says that they're going to offset that dollar for dollar against what they pay me. So essentially what that will do is eat up all the money I would get from disability,
Mm-hmm.
a pension lump sum, which I might want to do because the company I used to work for is undergoing intense litigation, and I'm concerned that my pension might not be there in 10 years when I'm 65.
Okay, so this is, obviously, Frank, I think you need to sit down with somebody because you can't make this decision on a phone call on the radio, okay? Because it's too much, but I can tell you my thoughts. Number one would be at 65 because it's regular retirement age, is your pension then protected against the disability repayment?
Yes.
Okay, so that's a big thing. Is there any reason why? I know you're saying you're fearful. Is it possible that you can roll that money over into an IRA? Is that money available to you through your employer?
I think if I did that, the insurance company would look at that as income.
They shouldn't, though. Can you hang on? We got a break for the news, and we'll talk to you on the other side.
Okay, thank you. Yeah.
All right, thanks, Frank. I'm Esther Golias, the tax lady from EG Tax. We'll see you on the other side. Okay, Frank, that doesn't sound patriotic. This is Esther Golias, the tax lady from EG Tax, and I'm just wishing everybody a happy Memorial Day. Thank you so much. If you are a first responder or you've served in the military, we just, as someone who hasn't, I just want to tell you how grateful that we are for our country, and we're grateful for your service, and wanted to thank you. But we have Frank who's been holding. So, Frank, thank you for waiting. Let me just say that whatever I tell you, we talk about today, you have to verify it with your employer and your disability people, because you want to make sure that you protect your disability if at all possible. But wouldn't you agree, Chris, that it should not be deemed income if he rolled over the money from his pension into an IRA?
Correct. I would not think that would be income at all.
But just double check, because that may be your answer. This way, it'll give you the comfort of knowing that you're in control. Number two, if it's not deemed income, and I don't see how it could, because it's still a qualified pension plan, and you haven't taken the money out. But number three, you want to make sure that they, for some reason, don't have some stipulation that if you had control of the of your pension plan, it would stop your disability. So that's what I'd suggest.
Yeah, I read the policy back and forth 100 times, and they have a page just dedicated to what they consider income. And from the way I read it, it seems that I'm up against it with this, that if I take it in a lump sum, I'm out that money.
No, this would not be a lump sum. This would be a rollover.
Okay.
So you would take your pension plan from work and roll it over into another, basically, individual retirement account. It's still a retirement account that you would get to control. So what I'd suggest you do, and if you want to call us on Monday, if it's hard for you to get around, we can do a three-way, or a Tuesday, excuse me, and we will call your disability people, and really it's worth a trip to your attorney to have him read it or she read it to make sure that you're covered, because I can appreciate your concerns, but you want to be smart about this.
Right, because I was told if I just leave the money there, it won't even be collecting any kind of interest or anything. It will just sit there for literally 10 years.
Well, again, I can't speak to that because I don't know, but this is what I'd suggest.
Okay.
You have your attorney read it, and if you want to do a three-way, we'll be very happy to intervene with you and help you to get to the bottom of it, okay?
I appreciate that. Thanks.
All right. Happy Memorial Day.
Bye.
I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 3930. And Chris, anything else you wanted to add over Frank's call?
Yeah, Frank, I mean, there's a lot of stuff going on there for Frank that you got to be really careful with what you're doing. Because if it is what he's saying, wow, that's incredible that they would control his pension with his disability. I've never heard of anything
But that's why if somebody reads it, and again, those kind of phone calls are so important, but I wouldn't do anything without investigating it. Okay, and we have Marie who's been holding. Hi, Marie. How can we help you?
Okay, I just have a couple of quick questions.
Yes, ma'am.
My husband has been on Social Security disability since his 50s, and he gets a disability check from the government. And I worked. Well, we retired 7 years ago. And my question is, we don't fill out income tax. So one of my neighbors was talking to me, and he said, what about these income tax things? And I go, we don't file income tax. He goes, you have to. He said, my niece works for the IRA, and I'll ask her. And I said, no, that's okay. I was just kidding. Do I have to file an income tax?
Chris, why don't you make her feel better?
Yeah. Income tax is all relevant upon income. So your income is Social Security, right?
Yes.
Yeah.
And what else?
Social Security disability for my husband, and he gets a disability check from the government. But we have some stock and stuff, which we don't touch except when you're over 70, you have to take so much out. So I just thought we didn't have to file.
Right.
Okay. So
Security.
your total, if your total taxable income exceeds, how old are you, Marie?
71.
Okay. So have you started taking your money out of your pension plan, your IRA?
Yes.
How much do you take out of there?
I get like $200 and some dollars. My husband gets like 97 from his.
All right. So you're getting around $300 from a pension and the Social Security. No other pension besides that?
No.
All right. So if your income is under 26.4, because you're over the age of 65, 26.4, 26.5, then, and it's not taxable, then you don't have to file a tax return. So you can stick your tongue out at your neighbor.
I got nervous about it.
In love. All right. No, but many people think that you have to. Now, there are people that don't have to file a tax return who want to file a tax return because they're still working or have dependents that are still in their household, and there's special credits that the federal government gives you in that situation. But if you're over the age of 65, you have no taxable income that exceeds $26,000, thereabouts, you don't have to file a tax return.
Okay.
Unless there was withholding, and it sounds like there's no withholding as well.
Okay, if I decide to get a part-time job, then I should make under the $26,000.
But again, your employer may start withholding. If they start withholding, then the only way you're going to get your money back is to file a tax return. But in your situation, you have no withholding, you have no kids at your house, right? There's no kids living with you, right?
Right.
Then you're good to go.
Okay, thank you so much.
All right. Thank you, Marie.
Thanks. Bye.
All right. Happy Memorial Day. I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. The other, another thing that people do that is shooting themselves in the foot, especially if you're a senior, is gambling income. Why would that be true, Chris?
Oh, because gambling, your winnings count as income, and your losses go on your Schedule A. So they think they don't have to pay tax on their gambling winnings, but with the increased standard deduction, it's harder to use your itemized deductions now. So your gambling losses for a lot of seniors don't even come into play. So now they're paying extra tax to the federal government where before they didn't have to. So they're going to start paying extra tax, and then depending on their income, it could actually make their Medicare go up through IRMA. It could end up...
And their Social Security taxability as well, right?
Yep.
So you got a potential, you have a potential that you're not going to get any benefit for itemizing. Your income is going to be taxable. Your Social Security could go up, and you could pay more Medicare. So that's a situation where even though you love gambling and you're having fun at the casino, you really got to think about it, because an extra $5,000 or $6,000 in gambling income even if you have $5,000 or $6,000 in losses, can negatively affect your taxability because it can make your Social Security taxable, could make your Medicare payments go up. So those are things that you really got to think about, because it seems benign, but at tax time it can really hurt.
Oh,
right?
Yep, definite.
Okay, let's go back to the phones, and we got Eugene. Hey, Eugene, how can we help you?
Yes, Esther, Chris,
Yeah.
you today.
Good.
Good, great. I have a question about New York State sent me a letter recently from Tax and Finance. Second year in a row they've done this. They've asked for my W-2 and W-4 forms and 1099s.
Mm-hmm.
And I filed my income tax back in March. I'm sure I sent those things in. Is this just a ploy by the state to delay my refund?
Chris?
Oh, yes. You gotta love New York. It is definitely a ploy. It doesn't seem.
And we cannot say what's in the mind of the state, okay? However, it does seem very super cautious that so many taxpayers have to reprove their W-2 information.
Right.
Yeah, they say it's for identity theft reasons.
Right.
So it's just remarkable how when you're dealing with the federal government, it's not an issue. The state of New York just seems to drag out these refunds as long as they possibly can.
Let me ask you this. If I wanted to get around that in the future, if I just took my refund and just applied it towards the next year's tax, or actually owe money, they probably wouldn't do that.
Well, I think changing your withholding at your job or your pension is the smartest thing to do, because what you want to do is, if you're waiting on a $500, $600, $800 refund, that can be frustrating. That's a lot of money to most people.
Right.
But if you change your withholding, so now you owe them at tax time $40, well then, if they want to question, you're not waiting for your refund. You sent them the money. If you have to send them some proof, you can do it. But a lot of people are waiting substantial amount of times to get their money back, because the state says, jump through this hoop, jump through that hoop, jump through this hoop. And so, and many people give up. And so the refund stays with the state. So I think changing, and we've talked about this for years, changing your withholding on the federal and state level so that you don't get the big refund or no refund at all, and you put you in the driver's seat, is a very wise thing to do.
All right, very good. Listen, I appreciate your time again.
All right, thanks, Eugene.
All right, bye-bye.
Happy Memorial Day. I'm Esther Gulias, the tax lady from EG Tax, with Chris Fabian from EG Tax. Don't forget our Ready, Set, Retire seminar, which is next Saturday, June the 1st, at our corporate headquarters, where it's a hands-on workshop. We have experts that are going to be there, attorneys that aren't going to charge you. Mike Hayflick from the Financial Guys are going to be there talking about Social Security planning. Let's see, who else we have? We have Tim Eliason is going to be there helping people with health insurance. I mean, it's so great. And the bottom line is, we're going to help you to walk out with hands-on things, beneficiaries, wills, estate planning, life estates, all those kind of things. And we want to help you. So again, if you want to join us, you can register online at our website at egtax.com, or call Tammy on Tuesday after the holiday, and we have maybe 15 openings yet for the seminar. We'd love to see you, and we want to certainly help you. Chris, anything new that's happening in the land of letters?
Just the letters, right now we're seeing still seeing the healthcare letters, people who are on the marketplace and didn't realize they were on the marketplace. We have seen.
Now, what happens if you're in the marketplace and you got the letter? What is it they're looking for?
Because you have to do a reconciliation of your subsidy. So if the government's helping you pay for your health insurance, they want to make sure that they didn't overpay you or maybe underpay you, because sometimes you get money back. If you estimated your income at $40,000 and you made $35,000, you didn't get enough subsidy, so they'll give you money back. But if you estimate it at 35 and you make 45, you're going to owe the government money. So they need to see that 8962, that reconciliation form of that health insurance.
It's interesting. I was working with somebody yesterday trying to get health insurance, and she ended up with a $525 per month subsidy. And I said to her, now you want to make sure that you didn't underestimate your income, because you figure $525 a month that the federal government is kicking in for you, even though it might only be for 6 months, that's $3,150 that they put in for your health insurance. Now, if at the end of the year her income ends up to be $50,000 rather than $30,000, guess who's going to have to pay back the $3,150? And that's what these letters are all about that people are getting that went through the marketplace, who got a subsidy.
Yes.
Right?
And yep, and I know, F, we're up to a break. After the break, I want to say some ways to try to avoid paying back a subsidy, because there are ways to help.
That's true. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be back. I'm Esther Golias, the tax lady from EG Tax, wishing all of you a wonderful Memorial weekend. We thank all of the first responders, all those people that sacrificed everything for our country. And I myself, and I know I'm talking for Chris too, we're very grateful for everything that you guys have done, and have a wonderful Memorial weekend. And I know that it's we're holding up the memory of people that have passed on and gave them the ultimate sacrifice, but we're also thankful for this country. And so you got to do a hamburger or a hot dog on everybody and do a little smiling. So, okay, want to also talk about another thing that people do that they don't realize is that they move money from their traditional IRA to a Roth, and they just think, oh, well, the Roth is tax-free, right? And so how can that cost anything?
Oh, because it costs money now. It's not ever as good as it sounds.
Right. So if you have a traditional IRA and you want to roll it over into a Roth, remember the traditional IRA was deductible when you put it in. So whenever you take it out, it's taxable. And so you say, well, I'm not taking it out, I'm rolling it over. But you're rolling it over to a tax-free vehicle, so you got to pay the taxes up front. So be very careful if you're thinking about rolling over existing traditional money into a Roth, because you have to pay the taxes now. And it isn't as simple as it sounds, where you say, oh, well, then I don't have to pay taxes later. You may not have to pay taxes anyway, because up to $26,000, and it's going higher each year of standard deduction, you can take out that kind of money tax-free. So if you did have a traditional IRA and you utilize those that deduction, you can take a lot of money out of your IRA tax-free anyway. So really think about it if you're rolling your money from a traditional to a Roth. Right, Chris?
Oh, definitely. And the thing is, if you put the money in a Roth, you can't touch it to your 59 and a half. Yes, there's stipulations. It has to be in there over 5 years and all that. But the main one is that you have to be over 59 and a half. So if you meet the other two stipulations, you're still subject to a penalty on that growth. And people don't understand that.
Absolutely right. Okay, and the other thing is that people do is families want to do the right thing. They want to leave the biggest asset they have to their family, which many times is their home. And so what they do is they gift the house to the children. Why is that not a smart move, Chris?
Well, because that means the basis of the house flows over to the children. So if we'll say your mom and dad lived in a house, and they bought it in 1960 and they paid $20,000 for it, put $25,000 in improvements. Their cost basis is $45,000. That house may be worth $200,000 right now. So when mom and dad pass away, they don't get the inherited value. They get the cost basis. So they get $40,000. So the children will have to pay tax on that $160,000 when that house sells, compared to inheriting it, where they get the stepped up value and they'll pay no tax.
So if you inherit an asset, in other words, it actually goes after the death of whomever was the donor, and you inherited it, the fair market value on the date of their death is what your basis is. So in essence, if that house was worth $200,000 when mom and dad passed away and you inherited it, your basis is $200,000. If you sell it, no taxes. If the parents gift it to you, then it goes back to the original basis that mom and dad paid plus the improvements. That gives you an adjusted basis from what you sell it for when you finally sell it, if it is your house, and that becomes taxable to you. So making sure that it's inherited is good, but another way is what, Chris?
There's the life estate.
The life estate, right?
Yep, which is something that Jeff Katz and Dennis Kitchen and Mark Berry will be talking about next Saturday.
And so it's so great, in a life estate, it's so cool. Mom and dad get to live there for as long as they want. The tax bill still comes in their name. And over a period of time, more and more of the house is basically attributable to the heirs. And when mom and dad are finally pass on, when the children sell the house, in essence, there's going to be, again, no taxes or very little taxes due on that house, which is a great tool that you can use wanting to gift this to your heirs, and especially with the 5-year look back, where people want to stay in their house. They don't want the asset to go to a nursing home, and it's a phenomenal tool. And that's something we'll be talking about next week at the seminar, right, Chris?
Yes.
Okay.
There's a lot of information next Saturday that people can't. You'd be foolish not to come and listen. Or not even, right. Because it's not a seminar. It is a true workshop.
It's a workshop where that's one of the things when we were setting up this week for the workshop, we said we want to make sure we have the tables and the people are walking around so that you bring your stuff and you can ask us questions, and there'll be 6 of us from EG Tax there, right?
Correct. Yep.
Yeah, so to help you. Another thing that people do that is shooting themselves in the foot is that they're getting reimbursed from their employer and a flat rate, and so it ends up being completely taxable. Like, let's say you're an outside salesperson and your employer gives you $500 a month flat rate for you to go out and drive around and call on businesses. If you submitted an expense report as opposed to getting it as a flat rate, then that would be a tax-free reimbursement. So it's better to get a reimbursement than it is to get a flat amount of money from your employer. The one is taxable, the other one isn't. What would you rather do? You don't want to pay the taxes. So the important thing is to get a reimbursement plan. And if your employer is not aware of this, maybe the CPA that you're working with or enrolled agent you're working with at the company isn't aware of this, tell your employer you want to go on an accountable plan, because this way you're minimizing your tax liability. Right, Chris?
Yes. Oh, definitely, especially with the new tax laws. Sometimes it's even better to do the reimbursement and take a cut in your paycheck. Mm-hmm. With the new tax.
Exactly right, especially like over-the-road truckers or outside salespeople. It's absolutely true. And then the last thing I wanted to talk about is if you're somebody that's an employee, if you have a business and you have employees and you think that you're really being cool by giving them a 1099, that's not a good thing at all. Why not, Chris?
Oh, well, that is because they're not really 1099s, they're employees, and so then you can get in trouble with the Department of Labor coming in, and then you have to pay back Social Security tax, back workman's comp, which is a huge penalty per day. I think it's $5,000 per day where you don't have workman's comp.
So let's say that an employer has people in 1099s and they really know that they are employees. What should they do? Should they just say, let's stick my head in the sand and pretend it doesn't happen? Or should they change now?
Change now. Be proactive and get her done.
That's right. And again, EG Tax will help you with that, because if you are exercising control, you have somebody that comes in, goes home when you say, gets the hourly rate, you provide the equipment, you do the training. They're basically, you may expect them to do the work. That's an employee. And if you're paying them on a 1099, except for a very weird exception, that's an employee, and you got to put them on a W-2. You have to pay half of their FICA and Medicare taxes. You got to do a workman's compensation, and if you do it right, those kind of things are deductible to your business, and it saves you from having a gigantic problem if New York State wage and hour comes in. Right?
Oh, yes. Yes, ignorance is not bliss. When they don't care that you don't know, they're going to get you.
That's right. So I'm Esther Golias, the tax lady from EG Tax. This is Chris Fabian from EG Tax. We have, again, the seminar we want to invite you to, the Ready, Set, Retire seminar. You don't have to be retiring, but we just thought that was kind of a cute thing for everybody to understand that that's the goal. We're looking at retirement. We're looking at planning for your future. If you think that you'd be interested in something like this, you can go to our website at egtax.com. There's a section there, Ready, Set, Retire, to sign up. Or you can call Tuesday and talk to Tammy. She'll help you. If you're getting letters, just like we had these people calling during the show, we will help you. If you can't get to the office, we can do a 3-way call. The important thing is, just because you get a letter doesn't mean it's right. Don't pay it without a second opinion, okay? So have a hot dog on me. I'm Esther Golias, the tax lady. Until next Saturday, I'm Esther Golias, the tax lady, with Chris Fabian. Have a great week. Happy Memorial Day.